In this lecture, we're going to talk a little bit about below market value deals, and I guess I'll start with my opinion of them. I, there are below market value deals. So if you qualify market value as in what is the going market price for a given property, then that's your definition. And if it's below that price, then I guess it's below market value. But the reality with markets are they are relatively efficient, and therefore you only get property below market value, inverted commas, if you're prepared to accept some kind of trade-off, i.e. some kind of risk, or perhaps you have knowledge in a particular domain that means you can outcompete other people, or you simply have something that other people don't, like cash, or that you're a very strong buyer because you have a lot of cash. And with that in mind, let's just have a look at a few of these strategies and some of the trade-offs that I've seen in this process. Now, my general view on property investment is the less risk, the better. Pick an area where you have a competitive advantage. Maybe it's a domain of knowledge that you have. So, for example, perhaps you're a builder or you're very familiar with construction. Then great, you can tackle things like commercial to residential, and maybe look around for properties that fit, that have the right criteria. The growth is good, the demographics are good, the location's good, and so on. And therefore, if all of that stacks up, and you have enough cash to buy the property without finance and renovate it, then and turn it into somewhere nice that people really want to live in, then you got yourself a below market value deal, because the market value of this when done is higher than you paid by that definition of below market. But generally what people think of below market is the way they look at it is I can basically get free money, and that's just very unlikely. There's always a trade-off somewhere, unless someone actually just wants to give you free money. Maybe they do, maybe you're lucky. So another one is properties with tenants in situ, and as a buy to let investor, you kind of like having tenants in situ. PropertyData have sourcing software, so you can find these properties. We also have this in our systems. The issue with PropertyData is that for very hot areas, it doesn't work so well because there's at least a 3-day lag on when a property goes to market to when PropertyData get it, and that's a problem. So we've minimized our latency. So in very hot areas, which are very desirable, we're pretty much there, bang on time with new properties that come up. But for properties with tenants in situ outside of very hot areas, this is okay. It works. The difference between PropertyData, I guess, and us is that our systems are geared to dynamically filtering out property that doesn't fit. And so we can look at more areas, look at more property. I've got 3 analysts working with me. They look at hundreds of properties every day. And therefore we can find that needle in a haystack, or that diamond in the coal pit, or whatever you want to call it. We can find those deals. But you can too. It's just going to take you more effort, and maybe you have to work to narrower areas of interest. So anyway, let's just quickly look at this one. So this property here in Rightmove, Clough Street. So what's the issue here? Well, it's below market value because Clough Road, and by the way, I'll talk about this at the very end, some very useful extensions and add-ons that you can get, and we'll talk through some of those later on. Anyway, it's in M9. That's a good area. This is below market value. Let's say the market is at, say, 180, even 190 for properties like this in reasonable condition. So what's the problem? It's got a tenant in situ. That's not a problem, but this doesn't look like a very nice tenant. Look at the mess. So this is probably a tenant that you would not like to have as a landlord, because they don't treat the property very well, and the property needs a renovation. So your choice is you buy it with tenant in situ, you leave the property as is, but then you don't optimize your rent. And there's a whole lot of calculations you can do to work out whether the numbers work or not. But essentially, for this kind of area, it's probably worth renovating so that you can lift the value of the property and then refinance at a higher value. And therefore, overall, you have less cash left in the property after you factor in deposits and all of that stuff. So here's a good example of a compromise you have to make. And therefore, you might make an offer and you might say, well, it's subject to the tenant vacating. But what if this is a troublesome tenant? And what if this tenant will go to court and say, I'm not being evicted and don't, whatever? Then you've got to deal with court action. That could make the completion period overextended and just it'll be a mess. So that's a good example of a compromise situation. Here's another one. This is a nice property in Moston, and if you know Manchester, you know that North Moston is good, South Moston not so good. That looks like a nice house. Why is it £130,000? Well, it needs quite a lot of work. Fine, but they say in the details that it's probably a cash purchase, so that's a bit of a red flag. But you should be able to get a mortgage on this, right? It's a decent property. Nothing looks wrong with it. It's got a kitchen. You should be able to get a mortgage. It's in a good area. Well, you got to look closer. And it turns out that this property has issues here. That there was some work done. The lintel, maybe it was a wooden lintel. The back of the house is likely to collapse. If this had a survey, the surveyor would say that's not mortgageable because the back of the house is at risk of collapse. And that's an issue. So here you go. Yes, it's below market, but there's a catch, there's a trade-off. And finally, there is this old chestnut, which is we buy your house for cash. And this is a classic one. Now, what happens is that you can find properties that are genuinely below market value, but there's a problem. You've got to find those people who will willingly sell you the property. I don't have it here at hand, but people have written books on the topic, and the whole book rests on a simple premise, which is that yes, you can find these deals, but they have to be below market value. How do I do that? Well, if you're good at online marketing, and you identify a segment that's of interest to you, then you do loads of marketing and run loads of ads and build a brand, then yes, you can find those people who maybe are threatened with bankruptcy and they know that they've only got a certain amount of time before they got to get out, and therefore they want a quick sale, and therefore they'll sell the property cheap in order to achieve that quick sale. And this then ties into another theme, which is that you can find these properties if you find these motivated sellers. But it's an awful lot of talking to estate agents and whatever, because the reality is that this isn't necessarily going to be publicized. Sometimes it is, and there are ways of identifying a motivated seller. So, for example, price history is a good one. And again, PropertyData have this, where you can use their sourcing software, and you can look for properties where prices have declined recently, and then you can do your research per property. The issue with PropertyData, as I've said before, is whilst it's very good, it's not very good at scale. So that property, it doesn't give you much context. I mean, you can run a report on it, I guess, and just get some sense of what's going on. But it's just a lot of hard work. And we've built systems that just make it really simple. But you can use tools like PropertyData, or you can be one of our clients, whatever. But there are ways of doing it, and I've shown you how in this lecture series. So yes, to recap on the main points behind below market value deals, if there's a problem with a property and you're better equipped to deal with it than somebody else, great, you've got value there. There are also value segments. So for example, in Greater Manchester, which is a very strong area, there's an awful lot of foreign national buyers in that general area. And it's very difficult to get mortgages under £100,000, for example, for these people, and thus property that's under £130,000 offers relatively more value because there's relatively less competition. And therefore, if you find those little spots where the demographics are okay, the crime is low, capital growth is solid, and so on, then there's value, below market value, I would argue. Then we've also got this whole thing about motivated sellers and identifying those and so on. But all of this is very good and fine, but it's not very scalable. And actually, in the long term, the biggest win you will get for building value is nailing the capital growth, buying in an area that's going to do well in the long term with a good yield so that you get a good solid net cash return, or at least that's my opinion. And it's a rather boring story, but it's one that works and sensible people do it. But like I say, you can get these deals if you have some competitive edge over other people, or you're prepared to accept more risk than many others would.